Hi everyone and welcome to the first capacity development event of the 2022 spring meetings of the IMF. In today's talk, we will address the rise of digital money and the necessary measures to ensure that it's safe, efficient, and inclusive in nature. Digitalization of financial services and money is transforming today's financial system and economic landscape, and it is also driving demand for IMF capacity development. To take full advantage of the opportunities that digitalization brings and to mitigate the attending risks, country authorities are seeking assistance in areas such as regulatory and supervisory frameworks, monetary operations, payment systems, and currency policy. Our external partners help us meet that demand, and we are delighted that our leading donor, Japan, is represented today. But what exactly is needed to create a virtuous circle for digital money? I'm joined today by two IMF fintech experts, Tao Sun and Parma Bains, who will talk to us about the changing landscape and how adequate regulation can help ensure financial and economic stability, both at a domestic and international level. Mr. Akihido Yoshida, Deputy Director General of the International Bureau at the Ministry of Finance of Japan, will then share Japan's perspective and why it has decided to increase its support for IMF capacity building on central bank digital currency. And with that, I hand over to our first speaker, my colleague Tao. Tao, please.
You may wonder, what is digital money? Do you use credit cards or e-wallets? Do you use central bank digital currencies that are issued by central banks and recorded as a liability of the central banks? If the answer is yes, you are using or adopting some types of digital money. Yes, the confluence of new technologies is making various digital money increasingly used or adopted. A high level of adoption of any digital money can help achieve policy objectives, such as financial inclusion, while managing risk, such as cyber attack. What are the key attributes of a successful digital money adoption? If well regulated, digital money adoption should have four attributes: improving efficiency, lowering cost, strengthening security, and building trust in the payments and financial system. Its sustainable adoption highly depends on the service quality, on the distribution, circulation, and the redemption of digital money by payment service providers. What are the key requirements for ensuring a virtuous circle of digital money adoption? To ensure adoption achieves a sustainable level, digital money payment service providers should meet four requirements. First, harnessing digital technology. Second, developing business models that ensure cost recovery. Third, serving various use cases. Fourth, complying with regulation. In this process, some payment service providers could in fact develop into new organizations, such as platforms, which are often have payment and transaction data at its core, and all other financial activities organizing themselves around that function. These platforms serve in two-sided markets, where they build up economy of scale, economy of scope, as well as achieve network effects. What is the possible vicious circle to avoid? Digital money can equally induce a vicious circle that can, for instance, result in data silos, market power, anti-competitive practices, harmful to consumers and financial systems. So, how to ensure these platforms create a virtuous circle to encompass innovations and economic benefits, while preventing a vicious circle is an important question for policymakers and regulators. The IMF is receiving requests from member countries for capacity development on digital money. Taking central bank digital currency as an example, 4 categories of increasing complexity and novelty are emerging for member countries: exploration, design, patterns, and policy implications. And the IMF is gearing up to provide 4 capacity development products: bilateral assistance, regional workshops or conferences, analytical work, and pilot reviews. In this process, the IMF's capacity development program has received funding from Japan. The funding intends to strengthen capacity development in central bank digital currencies in selected low-income developing countries and emerging market economies. Thank you. Back to you, Ivan.
Thank you so much, Tao. Let's now go to England, where our colleague Parma Bains will explain the IMF's view on digital money regulation and how the IMF is assisting its member countries through technical assistance and training. Parma, over to you.
Thanks very much. And I'm going to start with a bit of honesty, Ava. Look, I know regulation isn't the most glamorous part of digital money, but the right policies are key to encouraging some of the virtuous circle that Tao just mentioned. Now, the Bali FinTech agenda is a framework that we use when we think about FinTech regulation. And the overarching theme of the BFA is probably my most important message today. Really, we need to ensure that that authorities can harness the benefits of FinTech, and that includes digital money, while managing some of the risks. And I'll try my best to explain how authorities can achieve this delicate balancing act with digital money. Now, in the payment space, innovation tends to come from, in the form of payment service providers like e-money institutions, and these are generally smaller firms. We tend to call them fintech startups. You can probably see them here on the left-hand side of this slide. But more recently, we've seen the growth of larger technology conglomerates, and they're more commonly known as big tech. But we've got to bear in mind that fintech innovation in the payment space can also happen through incumbent entities like banks as well. So authorities really need to make sure that they've strengthened their surveillance and they're able to monitor developments from all these different entities. And that could be through existing supervisory structures, or it could be through dedicated fintech units like innovation hubs, or through regulatory sandboxes as well. Now, in most jurisdictions, payment service providers, whether they're large or small, they're required to meet certain baseline requirements to protect both markets and consumers. And these requirements might be things like segregating and safekeeping consumer funds, it could be resolution, it could be complaints procedures, it could be operational resilience, it could be cyber resilience. And actually, those last two elements, Ava, they're particularly important for digital-only offerings because of the digital nature of the product, right? Because any system downtime could leave consumers unable to access their funds, which could, leave them with very little recourse to alternative means. And through our capacity development program, we've also observed that in some jurisdictions, certain payment service providers, they might already be too big to fail or too connected to fail, and that can have cross-border implications as well. Now here, policymakers will really want to manage risks around consumer protection, around financial integrity, around market integrity, and around financial stability as well. And for me, this is really important, right? Authorities should really ensure that regulation is robust, it's proportionate, it's in line with global standards, where those global standards exist. But it needs to do all of this without stifling sensible innovation. Now, new enabling policies like banking, they can provide new payment service providers with the ability to compete effectively against incumbent banks. Now, on one hand, This is good, right? Because it generates greater competition, it unbundles payments products from banks. But on the other hand, the expansion of big tech into financial services has a potential to reverse some of this unbundling and shift risks from banks to big techs. And these big tech entities might generate systemic risks, but they aren't regulated necessarily in every jurisdiction in the same way that incumbent banks are, particularly when it comes to prudential requirements like liquidity, credit, and operational requirements. They might just not be as stringent as they are for incumbent banks. And we've got to remember, right, we're also seeing big tech in some markets expand into new areas of financial services, and they're also providing key infrastructure to incumbents like cloud computing. And we cover some of these risks in our big tech fintech note that we published a little earlier this year. You can read that online. But I've spoken a little bit about the risks generated by the entities. I just want to talk very quickly about the technology. And we know that technology neutral is pretty much the mantra of financial regulation. But payment service providers might use new technologies with new risk profiles, and the unique risks these new technologies should really be considered a part of regulation and supervision. And so going forward, tech neutrality might not hold. Right? For example, the use of certain types of distributed ledger technologies that rely on certain types of consensus mechanisms might not provide for settlement. They might be slow, they might be expensive, they might be energy intensive. They could generate, in general, unacceptable risks for some authorities, right? And we explore some of these benefits and some of the risks from blockchains, and particularly blockchain consensus mechanisms, in a blockchain consensus paper we published in January. Again, I'd encourage you to read that. Now, this next bit might sound obvious, but it's important. When new technologies enable new business models, authorities should really consider any risks. Let's think about it this way. Certain types of stablecoin issuers, and certain types of stablecoins actually, have the potential to become digital money in the future. And they might introduce new intermediaries as part of their broader ecosystem. And these new intermediaries, reserve managers, network administrators, there might be governance bodies, wallets, and exchanges. And really, authorities would want to consider the interrelationships between these entities to understand where risks reside, and also how best to manage those risks. Now, blockchains are designed, and their aim is to decentralize and disintermediate financial services. And hey, I don't think that's a bad thing. I don't think that's a bad thing at all. But we've got to remember that with this growth, there's also been the growth of new types of centralized entities. And there's two things here, right? Firstly, these centralized entities that carry out core functions should really be authorized and licensed. And secondly, stablecoin issuers, those might be regulated according to either their use case or the composition of their reserves. So, they could fall under payments regulation, they could fall under securities regulation, or where these stablecoins are potentially systemic, they could be subject to proportionate compensation. And we cover some of this in the last October's Global Financial Stability Report, as well as a blog that we shared on the website late last year. So I'd encourage you to read that. That's a policy, right? But I want to share with you how we've used some of that capacity development. Now, our flagship fintech course has been delivered across multiple jurisdictions, and we've provided capacity development in the form of regional workshops on 13 different occasions. We've also provided bilateral capacity development to several jurisdictions across a number of fintech topics. Now, I'll take you back to last year. We provided some capacity development work, and we spent some time working with authorities in Albania to help operationalize their crypto regulation. It's called the FinToken. While not all crypto assets are likely to be digital money, our mission focused on potential challenges and practical implementation issues relating to the licensing of firms, as well as their subsequent supervision as well. And we worked, over the summer with primarily AFSA, which is the Albanian Financial Services Authority. We've got a fantastic team out there. But we also collaborated with the Albanian Central Bank, we collaborated with the technology regulator, as well as key industry participants, just so we have a holistic view of the market. And we provided training on critical components of crypto asset regulation, and we offered several recommendations related to internal processes, outreach, monitoring, engagement. Through that capacity work, we observed that in Albania, crypto asset activities at least seem to be relatively small right now, but the passing of the legislation has a potential to legitimize the market, and that could result in, growth in consumer demand, and that could increase reputational risks for authorities. And, this whole area has been a key area of capacity development requests for us. And the work that we do as part of FSAPs, engagement with standard setting bodies, as well as our own policy development, it allows us to respond to requests quickly and with expertise. So, Ava, let me just wrap up really quick. We're facing regulatory challenges that we couldn't imagine a decade ago. And we need to really ensure that we can balance the benefits and the risks of digital money to ensure that we keep moving forward while we're also protecting markets, consumers, and financial stability. But back to you in the studio.
Thank you so much, Parma. Next, we will go to Tokyo, from where Mr. Yoshida will share Japan's approach to capacity building on digital money. Mr. Yoshida, thank you so much for joining us. The floor is yours.
That is my side. And thank you for giving me the opportunity to join this panel, along with the two experts from the funds. It's truly a privilege for me to be here. Most audience should be familiar by now with the pros and cons of the digital money. To be clear, I'm following here the fund's definition of digital money, which includes CBDCs and stable coins, but does not include unbacked crypto assets like Bitcoin. On bright side, digital money can improve the efficiency and spread the speed of payments, including in the cross-border context. Digital money can also promote financial inclusion, allow more people to access financial services. At the same time, digital money poses a variety of risks. Specifically, acute risks have been allotted in relation to market integrity, cyber attacks, illicit financing, data privacy, and stability of the international monetary system. So if countries make premature or inadvertent decisions to issue or accept poorly designed digital money, they could run the risk of undermining their own monetary sovereignty, domestic financial stability, and ultimately the stability of the international monetary system. Market capitalization of stable coins is steadily increasing to exceed $150 billion these days, entailing significant financial stability risks. The IMF should keep careful monitoring of the developments and send words of caution as appropriate through its flagship GFSR, Article 4 staff reports, FSAT assistance, as well as capacity development products or CD products. As for regulation of stable coins, we believe the IMF already has sufficient expertise in providing adequate advice to members, building upon its own past experience and common sense. More tricky part is how to advise on CBDCs. With only a handful of CBDCs actually being issued on the ground, it is hard, even for the very competent IMF staff, to come up with practical advice on how to tackle this new creature. It is true that there are less concerns in the case of CBDCs about issuers' credibility or compliance with regulations than for stablecoins. However, if they are not prudently designed and attendant risks are not well managed, CBDCs could have significant negative spillover effects beyond borders, thereby posing stability risks to the entire international monetary system. The ongoing geopolitical tensions will increase the risk of payment system fragmentation, which could be accelerated by the presence of digital money. Against such background, Japan strongly supports the IMF taking up the digital money issues, especially CBDC, as the core of its mandate. Particularly, we believe that the IMF's capacity development activities to members trying to properly develop or accept CBDCs have utmost values under the current juncture. Let me highlight two specific features of the fund CD activities that we would like to see in this area. First, we want the IMF to take proactive approach in terms of integrating surveillance and CD, a principle Japan has long been supporting. Premature introduction of CBDCs without careful consideration of attendant risks may endanger the regional and international monetary stability. While CDs should in principle be provided on a demand-driven basis, we encourage the IMF to explore identifying urgent CD needs of individual countries by closely monitoring their readiness for issuing or accepting CBDCs. Depending on individual circumstances, staff may advise on CBDC design and robust regulatory framework to mitigate relevant risks from issuing their own CBDCs or accepting foreign CBDCs. Second, we want the IMF to advance its analytical work in CBDCs and put together some tangible document summarizing the outcome, also in support of its future CD activity. For the fund's guidance to be truly useful and practical for members, the analytical work should cover not only purely technical issues such as project management, but policy issues as well. More specifically, the prospective topics to be covered include classic fund themes such as implications for financial stability, as well as cutting-edge themes such as privacy and fiscal issues. Public policy principles for latest CBDCs, published by the G7 last October, should also provide useful guidance. The IMF's CD activities, particularly in relation to digital money, are key to ensuring that the global economy can harness the benefits of digital technology while addressing the relevant risks. As a long-standing leading donor to the IMF, Japan stands ready to strongly support the fund's CD activities on digital money through its dedicated trust fund, JSA. Digital money has huge potential to transform the global financial landscape and human society as a whole, but it needs to be handled with care, given the large potential negative spillovers. It is no exaggeration to say, in my view, that the stability of international monetary system in the new digital era will largely hinge upon the success of the IMF CD activities in this area, especially CBDC. Japan is honored to lend its humble support to this important endeavor. I hope the other members of the IMF, together with our colleagues at the IMF, will join in the daunting task for the benefits of the entire international community. Thank you very much.
Thank you, Mr. Yoshida. And let me follow up with you directly. I will also have questions for our other speakers, but let me ask you first, why is Japan so interested in the fund's capacity development activities on digital money, particularly when it comes to central bank digital currency? Does it reflect the domestic discussions about a digital yen?
Thank you for an excellent question. As far as Japan is concerned, we have relatively high ratio of national debt, and the general public's call for issuance of digital yen is not so eminent, at least for now. The issue of digital money is recently gaining public awareness, however, and Bank of Japan has just entered the second phase of their pilot exploration for digital yen. Above all, however, Japan is one of the greatest beneficiaries from Stable's international monetary system for the past 70 years since its accession to the IMF. And this historical background explains why Japan is so keen to maintain the stability of IMS and to remain the leading contributor to IMF CD activity to support IMS. You may wonder why the Ministry of Finance and not the Bank of Japan is so keen to follow up on the issue of digital money. But remember, stability of the IMS is one of the wider public policy objectives beyond narrowly defined mandates of central banks. So there should be no wonder for our interests. Japan's Ministry of Finance is committed to supporting variable CD activities of the fund, including through its dedicated funds, JSF. Let me stop here.
Thank you so much, Mr. Yoshida. Tao, let me now turn to you. We've heard a lot about central bank digital currency. We've heard that countries are considering rolling out this kind of digital money. What's the fund's advice and view on this? Should countries indeed introduce central bank digital currency?
Thank you. That's a great question. There is no universal case for CBDC, although CBDC will be prevalent in most countries in various shades at some point in the future. Net benefits, implementation capacity, and the timetable will be country-specific. The decision to issue CBDC depends on factors including policy goals, central bank mandate, strength of the monetary framework, country circumstances, as well as regulatory implementation capacity and the legal environment. Thank you. Back to you, Ivan.
Thank you, Tao. And Parma, finally, let me turn to you. You mentioned in your presentation that growth of big tech is happening quickly in many jurisdictions. Could you elaborate a bit on this, and what are the risks and what might be regulatory options?
That's a tricky question, but we know, look, through our capacity development work, it's an area of immediate concern for many authorities. So it's a super relevant question as well. Now, the short answer is, where these entities are too big to fail or too connected to fail, requirements should really reflect the risks that they're generated. But look, we know it's not as simple as that with big tech, particularly because we know big tech might be headquartered in one jurisdiction, but they might offer their services across several jurisdictions. With these sort of fundamentally cross-border activities, a hybrid entity and activity-based approach split between home and host jurisdictions is probably the best approach. Now, conceptually, that's really appealing, but in practice, that could be quite difficult to implement. It'll take extensive cross-border collaboration. And an entity-based approach could take many forms, right? It could take the form of a big tech license. It could be systemic designation of a firm. It could be transforming part of a firm into a financial holding company. And that could take several years to put in place. And for some of these authorities, we know that they don't have several years because the risks are growing so quickly. So in the interim, some of the things that we share in that big tech fintech note I spoke about is that authorities should really require enhanced disclosures from big tech. And we also propose greater public and private collaboration to develop industry codes as well. Look, it's a fastly changing part of financial services, and regulatory authorities should really actively use all of the tools at their disposal to address the risks that big techs have in multiple jurisdictions across multiple activities and multiple business lines. I hope that's answered your question.
Yes, thank you so much, Parma. And thank you all for your presentations and insightful comments. Listening to you, I think there is no doubt that building capacity on the regulation of digital money will remain a strong priority for national and international financial institutions going forward, and we will certainly have much more to discuss in the future. Before today's event comes to an end, I would like to thank all of our external partners on behalf of the IMF for their crucial support for our technical assistance and training work. I would also like to thank our member countries, regional centers, and network of experts worldwide. Many thanks also to you for watching, and please join us again tomorrow at 10 a.m. Eastern for our talk on managing fiscal risks, as well as at 3 p.m. Eastern for our peek into training on the macroeconomics of climate change. Meanwhile, you can learn more on IMF capacity development by visiting our website imf.org/capdev, that's CAPDEV. Thank you so much. Arigato. Goodbye.